Stop everything. This silver courier cycle just changed the market. Something just moved, and most people completely missed it. Not a rumor, not a prediction, not another headline designed to scare you. This is a cycle, a quiet, mechanical shift in the way silver actually moves through the world. And when this cycle turns, markets don't just adjust, they reprice. The last time something like this happened, the people who saw it early walked away with generational wealth. The people who didn't spent years wondering what they missed. Right now, you're standing exactly at that crossroads, and what you are about to see changes everything. Welcome to Metal Market Chronicles, where we don't chase trends, we decode them. Now, before we go any further, if you're someone who has lived long enough to know that the quiet shifts are always the most dangerous ones, do us a favor, hit that subscribe button. Think of it like locking your front door at night. You did it for decades without thinking twice because you understood protection matters. This channel is that lock for your financial awareness. One click, that's all it takes. And one more thing, tell us in the comments, where in the world are you watching this from today? Because this story is not just hitting one market, it is hitting all of them. Most people never see the shift coming, not because they are not watching, but because they are watching the wrong thing. While analysts argued about price charts, while traders debated paper contracts, while the financial media chased the next headline, something else was happening, quietly, methodically, and almost completely out of sight. Silver was moving, not on a screen, not in an algorithm, not in a futures contract that would never see a vault, physically moving, truck by truck, vault by vault, country by country, and the people who tracked that movement, the ones who understood what it meant when real metal started changing hands at an accelerating pace. They saw something that the rest of the market was not ready to accept. A cycle had turned. For decades, the silver market operated on a simple and largely unchallenged assumption. Price was determined in the paper market. Physical delivery was secondary. The futures exchange set the tone, and the rest of the world followed. That system worked for a long time. It was efficient. It was liquid. It was familiar. But systems built on assumptions have a weakness. They work perfectly, right up until the assumptions stop being true. And somewhere in the last 18 months, something fundamental began to change. The courier cycle, the actual physical movement of silver from refiners to vaults, from vaults to industrial buyers, from one continent to another, started behaving differently. Delivery timelines stretched. Inventory at key storage locations tightened. The gap between what the paper market said silver was worth and what buyers were actually paying to secure real metal began to widen. Not dramatically at first, not in a way that made headlines, but for anyone paying close attention to the logistics layer beneath the financial layer, the signal was unmistakable. Consider how this works in practice. When a manufacturer in Southeast Asia needs silver for electronics production, they do not call a trader and buy a futures contract. They need physical metal. They need it delivered. They need it on time. When a government-linked buyer in the Middle East decides to add silver to a strategic reserve, they are not interested in paper promises. They want bars, they want vault confirmation, they want custody. These buyers operate in a world that is entirely separate from the world that most retail investors see when they look at a silver price ticker. And when these buyers start competing for the same limited pool of available physical metal, the courier cycle tightens, lead times grow, premiums rise, and the paper price, still being set in a market dominated by financial instruments, starts to look increasingly disconnected from the reality on the ground. That disconnection is not an accident. It is a warning. History has seen this pattern before. Not always in silver, not always in metals, but the mechanics are consistent across markets and across time. When the physical layer of a commodity market begins to diverge from the financial layer, it rarely stays quiet for long. The physical layer always wins eventually, because at the end of the day, an industrial buyer cannot run a factory on a futures contract. A government cannot build a reserve on a digital position. A refinery cannot process a spreadsheet entry. Real demand requires real metal, and real metal has to move through the real world. That is what the courier cycle measures, not sentiment, not speculation, not the mood of traders sitting behind screens in financial centers. It measures the actual friction in the system, and right now, that friction is rising. This is where the story gets serious, because when the courier cycle tightens in a market as strategically important as silver, The implications do not stay inside the metals market. They spread into industrial supply chains, into technology production timelines, into the boardrooms of companies that have quietly depended on cheap, accessible silver for years without ever stopping to ask, what happens if that access changes? That question is no longer theoretical. It is being asked right now in procurement departments, in sovereign wealth offices, in the corridors of institutions that do not talk to the press. And the answer they are arriving at is making them move faster than most people realize. Part 2 is where that movement becomes impossible to ignore. There's an old saying among people who have spent their lives working in commodities. The surface of the market lies, the foundation never does. Most investors never look at the foundation, they watch the price. They read the headlines, they follow the sentiment, and for years, that was enough. But right now, the foundation of the silver market is sending a message that the surface has not yet fully reflected. And the message is not subtle. Imagine a pipeline, not a metaphor, an actual pipeline. Silver flows through it, from mines in South America, through refineries in Europe, into industrial facilities in Asia, and back into vaults in New York and London. For decades, that pipeline had excess capacity. There was always a little more silver than the market needed at any given moment. That cushion kept prices manageable. It kept industrial buyers comfortable. It kept the paper market in control of the narrative. But cushions compress under pressure. And over the last 18 months, 3 separate forces have been pressing down on that cushion simultaneously. Not one force, not 2, 3. And that combination is what makes this moment different from every silver story that came before it. The first force is industrial acceleration. Silver is no longer just a monetary metal sitting politely in a vault waiting to be discussed at investment conferences. It is inside solar panels being installed across entire regions of Asia and the Middle East at a pace that would have seemed impossible a decade ago. It is inside electric vehicle components being manufactured around the clock in factories that run 3 shifts a day. It is inside the semiconductors, the medical devices, the defense systems, and the communications infrastructure that modern economies cannot function without. The world did not ask silver's permission before deciding to build the future out of it. And now the market is discovering something uncomfortable. There's not as much of it as everyone assumed. Industrial demand has been quietly consuming silver at a rate that stockpiles were not designed to absorb indefinitely. The numbers are not alarming on any single day, but compounded across months and years, they tell a story that procurement officers are beginning to find very difficult to ignore. The second force is Eastern repositioning. For most of modern financial history, silver pricing was a Western story. London set the tone, New York executed the trades. The rest of the world largely accepted the price that those 2 centers produced. That arrangement is under serious pressure. Sovereign buyers across Asia and the Middle East are no longer content to simply accept Western-determined prices. For a metal they increasingly view as strategically essential, they are building their own reserves. They are securing their own supply chains. They are establishing vault infrastructure that does not depend on Western custody arrangements. This is not speculation. This is observable in trade flow data, in refinery contract patterns, and in the quiet but consistent accumulation behavior of state-linked entities that do not announce their moves in press releases. When the East stops being a passive price taker and starts becoming an active physical accumulator, the supply available to the rest of the market shrinks, not overnight, but steadily, relentlessly. And that steady shrinkage is exactly what a tightening courier cycle looks like from the outside. The third force is the most underestimated. Tokenization, not as a technology story, not as a cryptocurrency adjacency, but as a demand multiplier. When a 28-year-old professional in Singapore can purchase a fractional claim on vaulted physical silver through a digital platform in 30 seconds, they do not think of themselves as entering the silver market. They think of themselves as making a smart allocation. But the metal backing that digital claim still has to exist somewhere. It still has to be refined. It still has to be transported. It still has to be vaulted and audited and held. Every new digital buyer creates a new physical obligation. And as that category of buyer grows, as digital rails make metal ownership frictionless for an entirely new generation of capital, the physical pipeline gets asked to carry more weight than it was originally built to handle. 3 forces pressing simultaneously on a pipeline that was never designed for this level of combined stress. This is not a prediction about where silver goes next week. This is an observation about what happens to any system when demand multiplies from multiple directions at once while supply remains structurally constrained. Engineers have a word for it: stress fracture. It does not happen loudly. It does not announce itself with a press conference. It happens quietly, in the places nobody thinks to look, until the day it becomes impossible to miss. That day is getting closer. And the people who are already repositioning are not waiting for the headline. They are watching the foundation. There is a particular kind of silence that precedes large market movements. Not the silence of nothing happening, the silence of everything happening. Just out of view. Phones being answered in offices that have no public address. Contracts being signed in languages that never appear in Western financial media. Metal moving through corridors that do not show up on the charts. Retail investors watch every morning. That silence has a texture. And right now, anyone paying close enough attention can feel it. Most people who follow silver think they know who moves this market. They picture retail investors, small buyers stacking coins in home safes, online communities debating price manipulation at midnight, individual traders placing bets on a Monday morning. And yes, those participants exist, but they are not the ones changing the structure of this market. They never were. The retail investor is the last to know, the last to move, and historically, the last to profit. The ones who actually reposition markets are quieter, more patient, and far more strategic. They do not post about their moves online. They do not appear on financial television to share their thesis. They simply act. And then, months later, the market reflects what they already knew. The first group moving this market is the one least discussed in public: sovereign wealth funds and state-linked accumulation vehicles. These are not entities driven by quarterly returns or shareholder pressure. They operate on decade-long horizons. They think in terms of national positioning, not personal profit. And when they decide a metal is strategically important, they do not buy a little. They build a position so large and so patiently constructed that by the time the broader market notices, the available supply has already been quietly reduced. What is observable right now in trade data and refinery contract behavior suggests that state-linked entities across multiple Asian and Middle Eastern economies have been accumulating physical silver with a consistency and urgency that did not exist 5 years ago. They are not doing this because they read a bullish report. They are doing this because they understand something that balance sheets cannot fully capture. In a world of sanctions, supply chain disruptions, and geopolitical fragmentation, a metal that sits at the intersection of money, industry, and technology is not just an investment, it is insurance, and sovereign entities are paying the premium. The second group is industrial, and their motivation has nothing to do with investment thesis. It has everything to do with survival. The procurement directors of major technology manufacturers, solar infrastructure companies, and defense contractors are not buying silver because they believe in a bull market. They are buying silver because their production lines require it. And for the first time in recent memory, they are struggling to secure forward supply at prices and timelines they can plan around. This is a critical distinction that most financial analysts miss entirely. When a speculator cannot get silver at the price they want, they walk away. When a manufacturer cannot get silver at the price they need, they panic buy. They lock in long-term contracts at unfavorable terms. They build emergency stockpiles that pull even more physical metal off the market. They phone competitors to find out if anyone has excess inventory. That behavior does not calm a tightening market. It accelerates it. And right now, that acceleration is quietly underway in procurement departments that will never make the financial news. The third group is the most unexpected, and in many ways, the most significant for what comes next. It is the emerging class of digitally native capital allocators. These are not the retail investors of previous generations. They are younger, more globally distributed, more comfortable moving capital across asset classes at speed, and they are increasingly discovering silver not through a broker, not through a coin dealer, but through digital platforms that make physical metal exposure as accessible as buying a technology stock. This matters enormously, because this group does not carry the psychological baggage of previous silver cycles. They did not live through the Hunt Brothers episode. They do not associate silver with doomsday bunkers and survivalist forms. To them, silver is simply a hard asset with industrial relevance, monetary history, and a supply constraint story that fits cleanly alongside the other strategic allocation theses they already believe in. When this group enters a market, They do not trickle in, they flow. Now consider what happens when all three groups are active simultaneously. Sovereign entities accumulating for strategic reasons, industrial buyers panic securing supply for operational reasons, digital natives allocating for portfolio reasons, three completely different motivations, three completely different time horizons, three completely different entry points, all converging on the same physically constrained market at the same time. This is what serious analysts mean when they talk about a multi-door entry phenomenon. The silver market is no longer dependent on one community of believers to sustain its momentum. It has moved beyond that. It now has buyers who do not even think of themselves as silver investors, showing up and pulling physical metal out of a pipeline that was already running tighter than anyone publicly acknowledged. And here is what makes this moment particularly important for anyone watching from the outside. Retail sentiment in the West is still not euphoric. The average person is not talking about silver at dinner tables. Financial media has not yet declared it the trade of the decade. The kind of broad social mania that historically marks the final stage of a major repricing move has not arrived. That absence is not a weakness in the thesis. It is the thesis. Because what it means is this: the sophisticated money has been moving. The strategic money has been moving. The industrial money has been moving. And the crowd has not yet noticed. That gap between what the informed actors are doing and what the broader public has not yet done is where the most significant market opportunities in history have always lived. The cycle is no longer building in silence. It is beginning to speak. And part 4 will reveal exactly what it is saying to the people who know how to listen. There's a moment in every major market shift when the warning stops being subtle, when the signals that were once only visible to the most careful observers start appearing in places that are impossible to ignore. Most people wait for that moment. They wait for the headline, they wait for the television anchor to confirm it, they wait for their neighbor to mention it at a weekend gathering. And by the time all of that happens, the moment has already passed. The cycle has already completed its most powerful phase, and the people who waited for permission to believe it are left standing at a door that quietly closed, while they were still deciding whether to walk through it. This is not a new pattern. History does not repeat in silver with perfect precision, but it rhymes, with a consistency that should make serious people uncomfortable. Go back to every major silver repricing event in modern economic history, not the ones driven purely by speculation, not the manufactured squeezes or the momentum trades that burned out in weeks, the structural ones, the ones where price did not just spike and retreat, but moved to a fundamentally new level and stayed there. Every single time, the warning came first in the physical layer. Delivery stress appeared before price discovery caught up. Vault inventory tightened before the financial media noticed. The courier cycle compressed before the chart gave any clean signal. The physical market whispered. And months later, the paper market was forced to shout. That sequence is not coincidence. It is the natural order of how real commodity markets correct when financial pricing has drifted too far from physical reality. And that sequence is currently in motion. What should serious decision makers actually be watching? Not the daily price. Anyone can watch the daily price. It creates noise, anxiety, and short-term thinking. None of those things serve a strategic mind. What deserves attention is far more specific. Watch the delivery ratios on major exchanges. When the number of contracts standing for physical delivery begins to rise relative to available registered inventory, that is not a technical footnote. That is a structural signal. It means buyers are no longer satisfied with paper exposure. They want the metal. They want it moved. They want it in their possession or in a vault they control. When that behavior accelerates, the courier cycle enters its most critical phase. Watch the premium spreads between paper price and physical price. In a well-functioning market, those spreads are narrow and stable. When they widen, when a buyer has to pay meaningfully more than the quoted spot price to actually secure physical metal for delivery, that gap is the market telling the truth that the official price has not yet admitted. It is the physical layer breaking away from the financial layer. And historically, the financial layer always follows. It has no choice. Because at the end of the supply chain, there's always a point where someone needs real metal. Not a position, not a contract, not a digital entry on an exchange ledger. Real, physical metal. And when that someone cannot get it at the price the paper market is quoting, the paper market eventually has to move. Watch vault flow data across multiple jurisdictions simultaneously. This is where the East versus West dynamic becomes most visible. When silver is quietly leaving Western vaults and reappearing in Eastern custody arrangements, when the geographic distribution of above-ground inventory is shifting, that movement tells a story about who believes they need to hold the physical asset directly, and who is still comfortable holding a financial claim on someone else's metal. Sovereign entities do not move their custody arrangements casually. When they do it, it means something. It means they have made a long-term judgment about where value will be stored and where risk will eventually surface. Now step back and look at the complete picture. A courier cycle that has been quietly tightening for 18 months. 3 separate categories of buyers converging on a physically constrained market simultaneously. Industrial demand that structurally cannot be walked back because the technologies requiring silver are already being built into the global economy at scale. A new generation of digital buyers creating physical obligations through tokenized products that the older market models never anticipated. Sovereign accumulation that is patient, strategic, and operating on timelines that make quarterly thinking completely irrelevant. Retail sentiment in the West that is still nowhere near euphoric, meaning the broadest and most emotionally driven wave of buying has not yet arrived. And a paper pricing system that is still functioning, still clearing, still posting numbers every day, but running on assumptions about supply availability and delivery capacity that the physical layer is quietly invalidating. This is what the cycle is warning. Not that silver goes to some specific number by some specific date. Anyone selling that kind of certainty is selling something other than analysis. What the cycle is warning is structural. It is warning that the old framework for understanding silver value, the one built on paper dominance, Western pricing authority, and the assumption of ample physical availability, is losing its grip on reality, not all at once, not with a single dramatic moment, but in the way that all structural shifts happen. Gradually, then suddenly. The gradually is what has been documented across these 4 parts. The suddenly is what serious people position for before it becomes obvious to everyone else. There is a reason the most consequential investors in history were not the ones who acted after the market confirmed their thesis. They were the ones who understood the cycle early enough to be already positioned when the confirmation finally came. The silver courier cycle has changed the market, not in the way a headline changes it. In the way a foundation shifts before a building above it realizes anything has moved. The foundation has shifted. The building has not yet noticed. That gap between what the foundation is saying and what the building has not yet felt is where this story lives. And the question that every serious person watching this must now ask themselves is not whether the cycle is real. The evidence across 4 parts has made that case. The only question that remains is a personal one. When the courier cycle completes its warning, will you be someone who saw it coming or someone who wished they had?